Many of us have so many subscriptions that we've lost track of what they all are. Well, companies also increasingly have subscriptions for services such as software and cloud computing. Add up all those customers, and the value they bring to the providers is a significant source of what they're worth. Have economic models caught up to reflect the trend? Welcome to the Chicago Booth Review podcast, where we bring you groundbreaking academic research in a clear and straightforward way. I'm Hal Weitzman, and today I'm talking with Chicago Booth's Amir Sufi, who's opened up a new area of research into customer capital and how companies develop it. Customer capital, Sufi says, accounts for a lot of the differences in how companies are valued between industries, and it might even have overturned what has been a cardinal rule of business, that revenue is more important than acquiring and maintaining customers. Amir Sufi, welcome to the Chicago Booth Review podcast.
Thank you.
We're delighted to have you here to talk about a whole new line of research for you about customer capital and what firms do with it. What is customer capital?
So the idea of customer capital is the idea that if we think about where firm value comes from, we oftentimes think, well, firms are bringing employees together, they're bringing physical capital, machines, equipment. What we're trying to point out in this paper is that the customer base that a company builds can actually be quite valuable to that company. And so we think of the efforts to acquire that customer base, to maintain it as a source of value, and we call that value customer capital.
Okay, so that seems just as a non-economist, that seems obvious that that would be important.
Right.
But is this something that other economists haven't really focused on?
I think most people, when they're thinking about efforts to win customers, they just think of it as a variable input cost. So I have to spend something to get you as a customer, you buy the good, maybe you buy the good at a price that's actually equal to more or less my marginal cost. So I don't even really make that much off any given customer. So I think what's new here is really thinking about the customer relationship as a dynamic long-term relationship, that if I get you as a customer, I actually get some profits from you for a long time going forward. And I think as the economy has moved more toward the types of business models that are more long-term in nature, this concept of customer capital becomes even more important.
That's interesting. The economy's moved more towards, so customer capital is becoming more important over time?
Yeah, that's one of the reasons I got super fascinated with this. So for example, we know a subscription-based business models.
Right.
So thinking about your subscriptions to the New York Times, we oftentimes think in terms of our own self, like just what are our subscriptions, but it also is the case that businesses now have a lot of subscriptions with other businesses. So think a software company that's selling to a legal firm, and those have become more and more common over time. So that's just one example. Branding, loyalty, those are also ways of having like longer term customer relationships, and those are also becoming more common over time.
That's interesting. I'm just now thinking about my own subscriptions. I have a subscription to a HVAC company, which I'm always meaning to cancel. But these are that increasing part of the business model is kind of tying us into these longer term relationships there.
Yeah, exactly. And that HVAC example is actually a perfect example. So I'm guessing you pay a pretty substantial fee based on
I think
how
it's
much
$20 a month,
yeah,
which
and
is
you probably don't
complete
use
waste.
it that much. And
Yeah.
so really the HVAC company, when they get you as a customer, you are now part of the value of that HVAC company because you are paying that $20 every month, and they may not actually be servicing your equipment nearly enough to justify as much. I'm sorry for your HVAC company. I don't mean to tell them they're ripping you off, but maybe they are.
They're very good, but they have locked me in. They've got me by the whatevers.
Yeah.
So this is an increasingly important part of the structure, the way that companies consider their value. Now, they personally consider their value. So I would say, you know, private equity company comes to buy me, my HVAC company. Well, we've got Hal Weitzman as one of our customers. So
Absolutely.
And 100 other people.
Yeah, absolutely. So that's one of the things we're able to show in the research, because when a public company acquires another company, they actually have to show you what exactly are the sources of value that they're getting. And in that, they'll list our customer relationships are valuable. So you're part of that value, you know. Hal Weitzman is in that customer relationship bin, and they're going to tell you, here's how much value we get in terms of those future payments that Hal is going to pay us. And so
I see.
that
It's
is
kind
the
of like
source
it's
value.
like buying mortgages.
Yeah, exactly. And so there are actually ideas out there right now to try to think about how to borrow directly against the value of those customer relationships. And so that's something we talk a little bit about in the paper.
In your new line of research about customer capital, you talk about acquiring and maintaining customers and how that should be treated as an investment and not as a cost or an overhead. So I guess my question is, are companies currently treating it as an overhead, or are they treating it as an investment?
Yeah, so if you look at, for example, the way accounting is done, investment is usually something that you don't subtract off of your revenues as a cost. You think of investment as something that is dynamic and is building your value. And so when...
And that would be things like R&D and...
Exactly, R&D. Even R&D right now is expensed. You think a little bit more about, for example, buying a computer or buying, investing in a new plant. That will all not be expensed. It won't be directly subtracted off revenue when you're calculating, for example, your operating income. In contrast, your efforts to do sales and marketing, the money you spend on your sales force, on advertising, that is directly expensed from your revenue. And so it is counted more or less by the accountants as a variable input cost, not as an investment. And I think for that reason, a lot of the accountants have said some companies are really being undervalued because it looks as if they have low net income or low operating income because they're spending so much on sales and marketing. And so especially for really fast-growing like software companies who are spending huge amounts on their sales force, if you look at the way the accounting is done, you may conclude, oh, they're not very profitable. But in fact, those are investments that are going to yield huge amounts of revenue in the future, and so they may very well be
That's so interesting because, if you think of the classic examples, the Amazons, the companies that in the 90s and noughts that acquired huge numbers of customers but had no revenue,
Exactly.
Facebook.
Yeah.
And then it turned out to be a good idea to acquire all those customers. They were investing essentially for the longer term, right?
Right, exactly. And I think that's one of the points we're trying to make. And in fact, those companies that you're mentioning are exactly the kinds of companies that are growing over time in importance. And they're the ones that have more dynamic long-term customer relationships. And therefore, the industries where you're seeing more and more spending on sales and marketing are the most fast-growing parts of the U.S. economy. And so that's kind of why I want to do more research on them.
Yeah, it's fascinating because, of course, the gospel was that, you can spend a lot of time and energy acquiring customers, but who cares if you have zillions of customers? What you need to have is revenue. But it sounds like actually that wasn't the case.
Yeah, because the customers today that you're acquiring will eventually lead to a lot of revenue. In fact, in the classic model of how to do this customer capital investment, the firms actually offer you a discount up front. So they offer you the discount up front because they know once they have you hooked into that relationship, they'll be able to jack up the price in the future and get a lot of revenue for.
I mean, in part, it sounds a bit like the sort of classic banking thing, where the banks give you no interest, but they assume that most customers just don't switch. Yeah. Does it, to a certain extent, depend on kind of inertia?
Yeah, in fact, in the banking literature, our paper doesn't really focus on the financial industry, but banking scholars have talked about what they call the deposit franchise, which is somehow you're willing to put your money into banks and get a very low interest rate relative to market interest rates. And my view is that our findings have that exact implication, that they're advertising, they're drawing you in, they're getting you to start using their payment services, and as a result, they can then pay you a low interest rate on your deposits and make money from you because they take your money and they put it in the market interest rate, which is higher. And so that is a form of customer capital. Now, you are part of that deposit franchise. I think another way of thinking about the deposit franchise is as customer capital, as depositor capital. You're basically making money off these depositors.
So apart from accounting, it sounds like it does matter whether you consider acquiring customers an overhead or an investment, because if you're about to be bought, it makes a difference to the value of the company. So, you want it, if you're going to be bought, you want it to be considered an investment, not an overhead.
Right, absolutely. And that's one of the critical results of the paper, which is if you actually look how the market values the company, the market gets it right. They understand that your efforts at sales and marketing are valuable and they're leading to valuable customer relationships. And so if you look at a company like any subscription-based company that makes a lot of them are software companies, really, you'll see that their enterprise value relative to their physical capital, that ratio is super, super high. And you might think that's a mystery. Why is the market valuing a company that has such a little amount of physical capital? And the answer is kind of intuitive. It's because that company has a ton of relationships with customers that are super valuable. And so that's like one of the critical ways in which our research tries to prove that sales and marketing should be considered an investment, the companies that do the most sales and marketing generally have high valuation ratios when you look at enterprise value to physical capital.
So this customer capital is a lot of the difference in what you identify as intangible capital between companies, between industries. Is that what we used to call goodwill? Is that the same thing, intangible capital?
So goodwill is generally the assets that you cannot easily separate from the rest of the value of the company. They're so integral to the company that you can't separate them. In general, part of customer capital will show up in goodwill, but one of the things we show in our research is that when you sell your company, some of that customer capital is considered like a separable asset. A classic example of this would be a brand. So there's a very famous transaction in the past for the company J. Crew, where J. Crew literally assigned a direct value to the brand J. Crew and treated it as a separable asset. So it's kind of an interesting point that sometimes it'll be in goodwill because it's all combined, but these assets sometimes are so valuable that they can be separated. Another classic example is Toys R Us, the brand name. That company was liquidated, but the name brand Toys R Us still exists and is still valuable. So those are assets that can ultimately be separable.
It's fascinating because sometimes those companies, you mentioned Toys R Us and Home Depot being another example, they will sometimes hive off, won't they, their intangible assets, put them in a separate holding company and then pay themselves for the use of those intangible assets.
And the rise in intangibles is really where I started getting interested in this whole area, because it just seems like the U.S. economy is more and more headed towards companies that are valued because of their intangible capital. And most of the previous scholarship had really emphasized things like knowledge capital, organizational capital, but we really wanted to put on the forefront really customer capital is super important. Things like brands, things like long-term customer relationships. And so these examples of Toys R Us on these brand values, it does add this interesting complication that it makes regulation and thinking about where companies' assets are a lot more difficult. That's one of the things that's very interesting about intangible capital.
So is brand also part of customer capital?
Absolutely. Absolutely. Yeah, absolutely. So when you're thinking about advertising and sales and marketing, one of the things you're doing is building your brand value. So we do consider that as one of the main aspects of customer capital. And think about it in terms of the dynamic customer relationships. Why is a brand valuable? A brand is valuable because somehow it elicits a response in you that you're willing to continue buying a product at higher than marginal cost. You're willing to pay extra because somehow the brand either makes you feel good or you think that it represents some kind of quality. But for whatever reason, it really is about getting you to pay more than marginal cost for that good.
Amir, Sufi, in the first half, we talked about customer capital and that it's part of the value of a company. But of course, you're an economist, so you're into measuring things. How do you measure customer capital?
So the first way
or investment in customer capital.
The first way is kind of the most obvious. Just look at the income statement. And it turns out that a lot of companies actually break out their broader expenses and have a line item that is sales and marketing expense. And we were able to be clever about finding the right data providers that actually break it out. And so that was a real big kind of jump forward in the project. So
sales and marketing, by definition, is part of customer capital because it's acquiring customers.
Absolutely. Well, it's the investment in customer capital. It's the way in which you actually obtain the customers and therefore leads to the value. The second thing we did was really leverage these new large language models, AI, people are calling them. We use Gemini, Google's Gemini, because firms actually describe in a lot of detail in their SEC filings, their 10Ks, the efforts they're putting forward in sales and marketing. And so this was a great way for us to kind of really learn what these large language models can do, what AI can do, and it's remarkably efficient at processing that text. So if a company talks about their sales and marketing, says it's about building brand value, it's about getting new customers, it's about employing a sales force, we can detect all of that using AI, and we do it for the full sample, which is like 55,000 firm year observations. So we could never do it with people. We could, but it would take forever. These AI techniques make it easier.
Okay, excellent. So now you've got these great findings. What are they? What new things did you find out about investment in customer capital?
Yeah, the first main thing is this just real striking variation across industries. So some industries, think mining, think upstream manufacturing, they spend almost nothing on sales and marketing, on investing in customer capital. Whereas software, business services, anything in the kind of high-tech area seems to spend a lot. In fact, high-tech manufacturing goods, think about computer and peripheral equipment manufacturers or medical equipment manufacturers, they spend huge amounts on sales and marketing. And one of the cool things about using the AI with the text is we can figure out why. And there, for example, for medical manufacturers, they say things like, look, these are really technical products. We have to meet with the customer. We have to explain the product. We have to make sure it works with the customer. And so you can really see the guts of why this works and why this creates valuable capital.
And you find in your research that investment in customer capital is huge. By some measures, spending on sales and marketing exceeds spending on research and development and capital spending. Was that a surprise?
That was a surprise that it was as low. I kind of thought it would be higher than R&D. I didn't realize it would be almost as large as general capital expenditures on physical equipment. So it kind of turns a lot of our notions of what firms are doing on its head. Like we think of a firm opening up a plant, spending money on equipment in the plant, spending money on computers, hiring workers. It turns out when you look at the amounts they're spending on sales and marketing, they are comparable to the amount they're spending on capital expenditures on physical equipment. And so when we think about what firms are doing to invest, we really should have sales and marketing, investing in customer capital way up high on the list.
Okay, and so you found a lot of variation, though, in who's that you said. You know, some of the companies are spending not very much. So you talked a little bit about that. It makes sense that mining companies wouldn't.
Yeah, they don't really need to.
I mean, don't know a lot about that industry, but I'm guessing that it's less important than, you know, selling sneakers or whatever, right? So does that intuition kind of play out across all industries?
Yeah, in a lot of ways, what I thought was interesting is that when I was talking to some of my PhD students about the project, I was saying like, a lot of the ways we think about firms are like stuck in the like 1920s thinking about like Henry Ford, you know, like building plants and putting workers together in the right way. And that probably still well describes some industries like mining and oil and gas exploration and maybe some upstream manufacturing firms like coal manufacturing, you know, or plastics. But it doesn't really describe most of the economy in terms of how we interact with it. Most of the economy are firms that don't really have a lot of physical capital, but they're hugely emphasizing the importance of getting customers and winning those customers and keeping those customers. And so those are the industries, I think, that are the fastest growing parts of the economy.
But does it tend to be more like the B2Cs that are doing it?
No,
or?
B2B actually. So software. So there's this whole industry. I don't know if your listeners know this, like this term SaaS industry.
Sure.
Software as a service.
Right.
SaaS companies spend huge amounts on sales and marketing. Business services. So think about H&R Block. I mean, how many H&R Block, you know, advertisements do we see around this time of year when they're trying, or TurboTax, to try to get people to sign up for their tax services. So these companies don't have almost any physical capital. I mean, they have computer equipment, they may have renting some places to have workers, but it's really this customer capital that ends up being most important there.
Now, your research is descriptive, right? You're describing what companies are actually doing, but is there some kind of recommendation there? I mean, should companies be thinking about investing more in customer capital?
Well, I think there's a broader question about how useful is any of this from the broad perspective, and that's something that we don't really tackle in this paper. But I kind of think of polar examples. So one example, in fact, some scholars at Booth and other places have been working on the idea that people sign you up for subscriptions and then you forget to cancel and then you end up paying more than you really want to pay. So we don't think of that as so socially valuable, about companies just trying to get you to pay for things you don't really need. But on the flip side, the medical technology example I gave, where a company's really spending to try to tailor the product to your preferences, to really make the product the best for you, that seems pretty socially valuable and something that we want companies to do. So it's not something we tackle in this paper, but it's something I want to look forward to working on in the next one.
One does get a general sense that customization is becoming more and more available, you know, all sorts of products, right, like you say.
And I think that's partially socially valuable in that if it is customized, you probably do like it better. But at some point, you know, if you're buying toothpaste and there's 100 types of toothpaste, you have like the raspberry, you know, at some point it does seem a little bit silly. Like, do we really need 100 types of flavored toothpaste? So it's a hard question to know whether this is just about winning new customers and catching them and getting them to pay way above marginal cost, or is it really making the customer better, making the customer happier in what they're buying?
And more connected to the company, it sounds like.
Exactly. And so that could go either way. And so even the subscription-based model, you know, I give you a subscription, but maybe I then have a closer relationship with you and you trust me more, that I'll show up when your HVAC system breaks down. They'll actually be there for you.
Coming back
right?
to my
So-
example, or I suppose just by default, they're the first people you call because you're paying them anyway.
Exactly. So this is the thing that I want to tease out in the next round of research.
Okay,
that
yeah, well,
this-
tell us about that. What are you thinking about next with this?
Yeah, so next I think we're going to first try to think about more detail in terms of whether customers are made better off from these relationships. And so I mentioned we have some scholars at Booth, other scholars at Stanford have been looking at this idea of subscriptions and seeing that people overpay for subscriptions. Sometimes you only see people drop their subscriptions when their credit card expires, for example, which is pretty good evidence that they didn't really want the subscription. They just kind of forgot they had it. So trying to push that and see if that's really what's driving the patterns in this paper is something we'll probably do in the next
Okay,
next
well, we look
version.
forward to talking to you more about customer capital. But for the moment, Amir Sufi, thank you very much for coming on the
Great,
Chicago
thanks.
Booth
Thanks for
Review
the time.
podcast.
I appreciate it.